Hey everyone, welcome to the KE Report in a daily editorial on Friday, June 6th, chatting with Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark II Market website, which I will link to in the show notes. Mark, let's start off with the news of the day being the US jobs data. A real mixed bag here. We saw May payrolls rise by 139,000, 13,000 above expectations, but the prior 2 months were revised down quite a bit by a combined 95,000. There's a large decline in the household survey of almost 700,000 jobs. The unemployment rate didn't move, though, held at 4.2% for a third straight month. There's all kinds of moving factors in this jobs data, and it really ends up just being a wash. So I'm curious in terms of what you saw in this jobs data. Anything stand out to you, either concerning or on the positive side?
Yeah, I think that's important. I think the how the jobs market is hitting current psychology because remember coming into the report, we had a very weak, a dismal ADP private sector estimate. We had the climbing weekly jobless claims, and we had some soft survey data. So the market became more bearish, and including people like myself, thinking that the risk was on the downside. Of course, the downside comes through the revisions, but still, I'd play down those revisions. I think that the way the Fed would look at it is not just one number, but some kind of like average. And so when I look at like the 3 month moving average, that has risen for the past 2 months. I think that the takeaway from the jobs data, the US jobs data, is simply that confirming the markets, what the market has done, which is move the next Fed rate cut into Q4. The market has also become a little bit more skeptical, only marginally, that the Fed will be able to deliver 2 rate cuts this year. And so I think the takeaway is really ends up to be supportive for the dollar. You know, the dollar made new lows for the year against half the G10 currencies in the past week. And I think the key question for a lot of people is whether this is a breakout or is it a true breakout? We should expect follow through, or is this going to be a false breakout? We should expect consolidation in the week ahead. And I'm thinking that we get some consolidation, partly with the help of what I expect to be a firm CPI reading next week.
Well, Mark, you bring up an interesting point about the jobs numbers and how that translates over into what the Fed's going to do. I think for a lot of people, the economic data is not nearly front and center as it was, let's say, a year or two ago, where every jobs report, every inflation report became like a huge dithering of what different market participants thought the Fed may do. Now it seems like the Fed has taken more of a let's watch and see stance all year long. We came into this year expecting 4 to 5 cuts, and now we're down to two, but probably just one cut. Do you think that it would have to be something more drastic to get the Fed to do anything? Because originally the markets came in on euphoria that there's going to be a lot of cuts this year, and that was going to juice the markets. But the markets have done just fine and seem to be ignoring or shunning some of this economic data.
Yeah, you raise a good point, Chad. You know, we've got the 2 year yield up 11 basis points today. In the US, we've got the 10 year up almost 10 basis points. But we've got a further extension of the stock market rally. So the stocks have done well despite the jump in US rates today. And in general, I think that the recovery since April has really forced, it might not have forced a lot of the large pools of capital back in, but it's definitely seen retail buying of US equities. So I think that the Federal Reserve is on hold. I think what they're going to do is their argument, I don't think really changes that much, and that is that the labor market is resilient enough, even if it's slowing gradually. It's still resilient enough for the Federal Reserve to be patient, given the high level of uncertainty. And that was really the key word in the beige book that came out this week ahead of next week, ahead of the coming up FOMC meeting. Uncertainty. And so I think in light of this uncertainty, the relative strength of the labor market, the Fed says that its restrictive monetary policy stance is still like appropriate, and this will allow inflation to still like curb, that is, the restrictive monetary policy can still curb price pressures.
I totally get why the Fed is still on the sidelines here. Outside of, again, the kind of chaos that politics in the US is causing with all these tariffs, just looking at the data, and we're almost halfway through this year, Mark. And in all fairness, coming into this year, we did have a number of commentators, and I think you were even on that side saying that this year could be tough for the US economy. There are also other people saying the economy will do just fine. And right now, what we've seen with data is that the economy is okay. Jobs are fine, albeit still gradually slowing. Inflation broadly stuck. It's not skyrocketing. It's not moving down to any great extent. It's just a whole lot of almost neutral, range bound action in a lot of the key metrics that the Fed will focus on. So, what's your assessment of where we stand now, almost 6 months through this year?
Yeah, I have a hard time figuring this out. And I'll tell you why. And it's because of the importance of the tariffs and how businesses and households have reacted. And so that we know that it terribly distorted Q1 where the economy actually did contract. And we know from this recent data that imports collapsed in April. And so beginning in Q2, then we're going to expect the distortion from the trade to be positive for the US rather than negative like it was in Q1. And so I think that how to look past the noise and try to find a signal. And I think that what a lot of economists will do is to look at this measure called final sales to domestic parties. And what that does, in effect, is it strips out inventories and trade. Because a lot of those goods that we were importing in Q1, say in March, when we had the big surge, went into inventories. And we've got a big drop in imports in April, and that would suggest that they're drawing down on those inventories. So we really got to get past this. And I think that this trade distortion, and we may not be able to get past it, given this like trickle. It's almost like this water torture of new tariffs or new tariff announcements almost every week. We at the end of last week, President Trump doubled the steel and aluminum tariffs. And this seems to be making trade talks go more difficult as we approach the end of that postponement of the so-called reciprocal tariffs, which is coming. It's about a month away now. So I think as an economist, as an investor, I'm going to be focusing on this sort of core measure of GDP, of final sales to domestic parties, excluding trade and inventories, to get a better signal on the U.S. economy. But I still think the U.S. economy is going to weaken. I don't think we felt the full force of what's going to happen yet. And I think part of the full force is going to come from the resumption of student loans servicing, meaning that's going to take about $500 per household away from consumption. I'm looking at a drying up of tourist inflows from Europe and from Canada. I'm looking at companies who are saying that they're going to be passing on some of the higher tariff costs to the consumer, but it also looks like they're going to be eating some of them, and that is to say, narrower profit margins. So I'm still concerned with the trajectory of the economy. And again, if you accept the idea that tariffs are a tax increase, we're looking at a very large tax increase in the U.S.
Yeah, we're just gonna have to see some of this month over month and quarter over quarter numbers maybe smooth out in the second half of this year to get a better signal, like you say, because it was very noisy in the first two quarters. Another thing I'd like to ask you about, Mark, though, is the quantitative tightening. One of the other tools in the Fed's toolbox is they've been continuing to reduce down their balance sheet. Some of that by letting some of the debt just roll off, but all in all, we looked at some of the numbers month over month, and there doesn't seem to be a clear pattern. Some people were under the impression it was getting lower and lower, that they may have to start supporting the bond market by buying in it. Do you buy that? Do you buy that the Fed is going to have to start reducing down their QT to support the bond market, whether they call it QE or providing liquidity? Is there going to be a need for the Fed to step in and start buying at least one portion of the bond market?
I'm not so sure I see this kind of a crisis level of stress that'll force the Federal Reserve to come back in to buy bonds to support the bond market, like they did in the UK at late 2022. And so I think the Federal Reserve is still on track. It's still allowing the balance sheet to shrink. And partly, of course, because of this passive approach, remember how it works. When the Fed's allowing its balance sheet to shrink, what it's doing is a certain amount of bonds mature every month. And they're not replacing all of them. And so it's a passive approach. And so partly it depends on the maturity schedule of what's in their portfolio, which you really have to get into the weeds to appreciate what they have by sort of a security issue number. But it does seem to me that, at the end of last year, the Fed's balance sheet was worth about almost $6.9 trillion, and it's now worth about $6.5 trillion. It is letting it fall, And I think that the bigger issue is what happens when they resume rate cuts. And if they have to go, a sequence of rate cuts, is that still consistent with QT? In the UK, they're doing that. They're allowing the balance sheet to shrink while they cut interest rates. And it does seem to be posing, it gives like contradictory signals in a way. The central bank cut rates, so that obviously pushes down overnight rates in the very short end of the curve. And while they're reducing their buying, it's really reducing the buying at the longer end of the curve, which maybe puts upward pressure on yields, and hence you get this sense of a yield curve steepening.
So as much as we hear about the Fed always being data dependent, what do you think moves the needle for the Fed here, Mark? What is on the horizon that would make the Fed A, start cutting rates again, or do something with their balance sheet, start buying bonds, go back more aggressively into some sort of a QE program, or even on the flip side, I guess, something that no one's really talking about is more QT?
Yeah, and I think the Fed, I mean, I sort of share your idea that sometimes bolder action is necessary, but I think the Fed is not like that. And I think that Yellen she sort of pushed back against some other criticism, saying that the Federal Reserve and the Treasury are not a hedge fund. And so the continuity, regular issuance, all this stuff kind of matters in a way that it might not matter so much for an individual fund manager. So what will get the Fed to change policy? I think what will get the Fed to cut rates, to resume its rate cutting sequence, is a deterioration of the labor market. And here I'm not just talking about non-farm payrolls. I'm really looking at the unemployment rate. Remember when the Fed issues its summary of economic projections, its dot plot, it doesn't have a forecast for non-farm payrolls. There's a forecast for the unemployment rate. So I think that inflation comes down a little bit more, perhaps after we get this May print next week, but that the real thing that gets the Fed to cut rates is not going to be that inflation is back to target, but it's going to be that you have a weakness in the economy reflected through the labor market. I think in terms of QE, I think the bar to new QE is relatively high, and I think you need a crisis of some kind. It's not just that the bond market sells off and the economy does better than people thought. And when you really look at it, there's this talk about a capital strike against the U.S., and it's hard for me to see it. While it's possible, here's what it looks like to me. The U.S. 10-year yield is down about 7.5 basis points this year. I know it doesn't sound like a lot, but it's more than the other G7 countries. Most of them have seen yields increase. You say, well, what about the equity market? Yeah, the U.S. equity market's underperformed Europe for sure. I've got the S&Ps up about 1.75% year to date. Pretty miserable for being halfway through the year. But it hasn't done better than Europe, but it has done better than Japan, which is down. The Nikkei is down about 5% for the year. It's also done better than China, which is, they say they're growing about 5%. Their stock market's down about 1.5%, the CSI 300. So I'm not sure that I'm seeing the kind of exodus and underperformance of the U.S. asset markets that would require a central bank to act quicker, more urgently, or use some kind of emergency facility. What I was suggesting too is, behind the scenes, the two financial moves that people are anticipating from the administration is one, somehow privatization in some fashion, in some form, of Fannie Mae and Freddie Mac. And the other thing is this supplementary liquidity requirement that sort of forces U.S. banks to have more capital put aside than sort of the international agreements. And I think the administration's committed to both privatizing, like I say, in some fashion, to some extent, Fannie Mae and Freddie Mac, and also getting rid of or diluting this supplemental liquidity requirement. That'll also support the Treasury market without having to go down the QE route. Of course, the other thing which people have stressed this week, kind of confusing it, I think, with QE, is the beginning under Yellen, the U.S. Treasury wants to improve the liquidity in on-the-run issues. Those are the most recently auctioned instruments. And so what they're doing to do this is they are buying back the less liquid off-the-run issues and then increasing the size of the coupons for the new issues. And so to me, this is going to be a net wash, even if it might have some individual bonds might be impacted. But generally speaking, I don't think this really is going to change the balance sheet or the monetary policy signal driven from the central bank's balance sheet.
Well, Mark, there's a lot of other central banks that are kind of on a different track than the Fed is on. And so it'd be nice to get into how those moves are affecting their bond markets. And then obviously that ties into the currency markets. As you mentioned, we saw the dollar index down at 98 this week. Some of that were some of these currency pairs were at extremes, but that ties into what their central banks are doing. So kind of make that a big holistic thought for us. How do the other central banks' policies affect their bond rates and their currencies?
Yeah, the bond rates are a bit more tricky, I think, because of the influence of say, the U.S. bond market, or even more recently, the big disruption in the Japanese bond market. But I think you're right, Chad, that central banks are not all on the same sequence or same cycle right now. It seems that what the ECB told us this past week, what the Bank of Canada suggested this past week, what Sweden and Norway have also indicated, it seems like they're getting close to, even if not at the end of their easing cycle. And then this is why people like me are still bearish the dollar on a medium-term view. These central banks are going to get done easing just as the Federal Reserve resumes its own easing cycle. So what are we talking about? Sometime maybe Q4, ECB is done, Bank of Canada is done, Federal Reserve might begin, or they might begin and resume their cuts next year. But the idea is that these other central banks are well ahead of the U.S. in a big like monetary cycle. And so this is the weakness, the pressure, I think, will be felt on the dollar. Long-term bonds, like I say, short-term interest rates seem to be influenced by central bank policy. Long-term rates, a little bit more difficult. It's almost like there's a global long-term market for capital. And so even when we talk about European bonds or corporate bonds, we really think of them as a spread to U.S. treasuries. And so I think that it's really like the U.S. Treasury market is still the anchor. And if you were to tell me that for maybe because of growth or for whatever reason, U.S. Treasury market is going to sell off, I'd say that probably puts weight on Europe. And the same thing when you have a big move like in Japan, which in some measures is a bigger bond market than the U.S. has. And we did see some stability in their bond market this past week, but it's very precarious. And I think helps explain why the European bonds have done a bit poorer than the U.S. bonds so far this year.
So, Mark, make sense of all this for me then. Where do we stand in the global financial system? There still seems to be a lot of capital out there. In the US, in terms of financial markets, we are again seeing very concentrated leadership that is helping the markets move higher. Markets are not crashing right now, but they are very, very volatile. Currencies, fine. The US dollar has underperformed a lot of other currencies, but again, it hasn't crashed. So, where do we stand in this whole world of the financial markets?
Yeah, I think that in the Federal Reserve's beige book, which came out this past week, and also I put it together like you mentioned a monthly note, and I also thought that uncertainty was like if there's one word we're looking for to characterize what we're going through, I think it's a high degree of uncertainty. And this was picked up in the Fed's beige book, and market observers like myself, and I think that makes this uncertainty makes things so that investors and market participants have less conviction. And I think this makes for this injects more volatility into the market. But I agree with you. The markets, the world still seems to be awash with liquidity. And not just because central banks are cutting rates, but even if you go back sort of old school and look at money supply growth. So it does seem to me that, that this may be the big argument against looking for a big asset market crash, is that there's lots of liquidity that the central banks are still providing. So I think that the world we're on the cusp of we sort of suspected these big changes coming from the trade. I'd say so far it's distorted the GDP figures, certain and other numbers. I mean, we saw this in Germany where they had a big jump in industrial production in March and then a big drop in April. So you're seeing the distortion caused by the tariffs and the front running of them. So I think we really don't have, I think, a good sense of where we are once we can get past or look past these tariffs. I think that's so immediate. And especially as we head into July, when those reciprocal tariffs, that postponement comes due.
Oh, we're still just waiting for tariffs, right? To see what those movements are, unfortunately. But hey, fair enough. It's not just central banks that are, in a way, handcuffed, I think, by what's going on in the world, but the data seems to still be hanging in there. And that is, in the end, what matters. We can forward project all we want what's going to happen to this data, but as it's come out throughout almost now the first half of the year, it's been hanging in there. I personally hope it still hangs in there, but hey, it's a very, very difficult market to navigate right now, but there are still great opportunities out there and still money being made. So, hey, Mark, great chatting with you. Again, Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark to Market website. I hope you have a great weekend, Mark.
Great. Thanks. Good luck to everybody.